Hi, everybody. Welcome. Shout out for everybody here from TGS. Just say hello. Yay. Thank you, TGS people. Okay, I'm going to assume that at least half of you are in a state of raising money or looking to raise money in the next year. And so I'm going to ask Jack to tell us how much trouble you people are in and what you have to look forward to. There are good sides and there are bad sides. Jack, tell people the real world right now.
So I'm going to reprise the role of the grumpy old man, seeing a few cycle turns over the years, beginning with the dot-com boom bust. Marc and I were talking about that earlier, and then the great financial crisis, and now the most recent turn in the market. So this is my hobby horse topic, but I feel it's something that all entrepreneurs and VCs need to understand, especially for our younger generation folks that have not seen a cycle turn, that have not seen interest rates above 1%. And so essentially, what I want to emphasize is that after the financial crisis, for 13 years, essentially, we had interest rates that were effectively zero. Money was very, very, very easy to come by. And so if you're raising money either for a fund or for a startup company, it was equally as easy. And that was great. And all sorts of companies got started. Many of them turned out very well, and many of them did not. But now that the cycle has turned and interest rates are effectively 5x what they were before, the cost of capital is a completely different conversation. And so if you are running a business that is essentially a science experiment that has no focus on cash flows and unit economics, those companies got funded 5 years ago because they were effectively like a zero coupon bond. So what I mean by that, the VC gives you money, you take the money, you say thank you very much, you come back to that VC in 10, 15, 20 years, and maybe if you're Elon Musk, you've built rockets and you're going to Mars, and that's fantastic, and you give your VCs a huge balloon payment. But now, even for Elon, no offense to Elon, former colleague, there's zero tolerance for those types of businesses. So the main point of emphasis on this topic, per Marc's question, is there is, for companies that are just trying to grow market share and top line revenue, which was kind of the du jour approach during this easy money period, things are completely turned on its head, where the focus is much, much more on unit economics, cash flow, path to profitability.
Okay, so that has a number of implications. First of all, maybe when you and I were in college, everybody wanted to join Goldman Sachs and Lehman Brothers. But what I've seen in 20 years of living in Singapore is the cult of entrepreneurship has become very, very strong. Right. Kids coming out of university are really looking to start their first venture very, very quickly.
Right.
That's going to dry up, or at least get a lot more competitive.
Right. And so it's funny because we didn't even talk about this, but yeah. I completely agree with your starting point there, is that when we were graduating from college, because we're basically the same age, I think, so all of my classmates wanted to go work at Goldman Sachs and be a derivatives trader and trade little pieces of paper back and forth that basically has no societal value whatsoever.
Yeah.
Zero, right? It pays really well, but it has no societal value. Fast forward to today, we have everyone wants to be an entrepreneur. So compared to Goldman Sachs derivatives trader, everyone wants to be an entrepreneur. This is far, far, far better, both for the entrepreneur and for society writ large. However, after 13 years of basically free money where everyone wanted to be an entrepreneur, it was like a game show. And we were speaking earlier, it's as if, where do I go get on the escalator and get off at the top and celebrate becoming a billionaire? That's not how it works, because being an entrepreneur, as we both know, it's more like this. And these bottom bits are the near-death experiences. And not everyone's cut out to have a near-death experience every couple months. Some people are cut out to go work at an accounting firm and start as a junior analyst, and 30 years later, once you go from A to B to Y to Z, you're the CEO, and you get paid very well, and you have a great career. That's fantastic, and you will have far less near-death experiences if you're working at the Ernst & Young equivalent versus you're trying to start the next PayPal. And so I think we, as entrepreneurs that have seen a few cycle turns, we have to be very honest with young entrepreneurs about what they're getting into, especially in this much, much, much more difficult capital environment.
So does that mean there's sort of a culling, and maybe we're going to remove a little bit of wheat from the chaff and produce maybe more dedicated, stronger entrepreneurs who, if they're going to survive?
That's exactly right, because allocating money 3 years ago, part of the job as a VC was trying to figure out, Is this entrepreneur in it for the right reasons, because they really want to be an entrepreneur, because they really believe in this business, because they really want to work 120 hours a week, or they just want to do it because this is the cool thing to do? So the culling of the herd, so to speak, has made our job as allocators that much better, because if you're a young entrepreneur that's trying to do a startup in 2023, you're certainly in it for the right reasons, which is great. So it's great because whenever there's a cycle turn, it's like there's a Darwinian process. And so it clears out the groups that probably shouldn't be in the game, so to speak, the weaker participants, and the ones that are left are the strong ones. And then when you have this Darwinian process, you've got the dog walking app or whatever nonsense it is, those companies just need to go out of business, because the dog walking app, as silly as that business is and was, probably has a team of some rock star engineers. And those rock star engineers need to get repurposed to go work at the next generation Google or PayPal or the equivalent.
Okay, so that brings up another point, which is the people that have raised money at ridiculous valuations in 2019, 20, and 21, they are running out of capital and will have to raise money in a new environment. That means down rounds. That means people are out of money. It creates a little bit of turmoil in the market. How's that going to play out?
Yeah, it's a great question. So it's a good news, bad news scenario. So the good news is if you raise money in 2019, 20, 21, the good news is that you have money.
Yeah.
The bad news is if you didn't and you're trying to raise it now, it's going to be really, really hard. And so going back to the good news, okay, great. You raised money. So I was doing a panel with a fellow senior guy from Andreessen Horowitz a couple weeks ago, and we were talking about comparing portfolios. And he was saying, which I think is about market average, his portfolio has portfolio companies have on average about 2 years of cash flow on hand based on burn. That's a lot of time. And so essentially what is going on now behind the scenes that no one likes to talk about out loud or in public is that for the VCs that made a ton of investments in 19, 20, 21, those investments, that will be the worst vintage of all time, especially the growth investments, all time. So what the VCs are doing now as quietly as possible is that they're triaging that mess. And they're trying to figure out who's going to live, who's not going to live, and then the gray area in between. And so what is going to happen, in my opinion, is that I was doing some research on this topic. I think at the peak of this last cycle, I think there were globally something like 2,200 or thereabout unicorns. So what's going to happen with this group of unicorns? So I think it's going to fall into 3 buckets. So one, to your point, I don't know what the percentages will be, but one component of these unicorns, they're going to have down rounds. They're basically going to price, because essentially there's no trading. There's no mark to market. So some component of these companies are going to have a down round. Structurally, they'll try to massage it, but they're just going to price down. Second bucket, there'll be companies that are going to have shotgun marriages, merger and acquisitions that are going to be forced upon them by their investors. And then the third bucket, which I think is going to be the majority, if not the vast majority, they're going to go bust. And normally, again, going back to their Darwinian comment, it would be better from a market cycle perspective to have more of a V. So have it come down, take your reckoning, take your bad medicine, and then come back out and be that much stronger. Because of all this easy money that was being printed for 13 years, it's much more of a U. So we've come in, we're in this long slog where I don't know where we are on the continuum, but we're definitely somewhere in the middle. And then once the cash begins to burn out truly in 2 years or whenever it is, then we can finally take flight on the other side. But it's still going to be a long process.
And from the investor point of view, if you're a fund raising funds right now, how difficult is that? And what's changed?
So what's changed is, as I said kind of in the beginning remarks, it's just a complete different mentality. If you can't articulate how you're going to make money in 2 years, 3 years, concretely, it's very difficult to raise capital. And the same thing is for a fund. If you're out there, so another kind of fun fact in doing some research for our talk is that I think, again, at the peak of the last cycle, there were something like 11,000 venture capital funds. I think now we're down, the numbers are hard to get, but I think we're down to about 8,000. I would argue that when it's all said and done and we get to the pure bottom point, 3,000, 2,500. So I'm not just picking on entrepreneurs. I'm just trying to be honest and have candid talk, but it's just as bad for funds because there were so many funds. Like think about how many of those 11,000 venture funds were created, first-time funds, after 2008. I don't know the exact number, but I would guess half, probably. Yeah. And so what happened, and I can say this, so I sit on the board of my college endowment, so looking at it from a investment committee perspective, so many of these funds, basically, they rode up this valuation wave, and then to their immense discredit, rode the wave down. And they didn't capture any gains up here. And so the bad news for them, when they try to go out to market as VCs, they will have no chance of raising money. So you almost have two categories of zombies. You have these zombie companies that have a lot of cash on the balance sheet, and they're trying to reinvent themselves, throw a Hail Mary pass, whatever it is. And again, some of those Hail Mary passes will be completed. Probably not many, but maybe some. And then you have all these funds that didn't crystallize gains, rode it all the way down, and they're basically just plain management fee ventures. They're going to sit and just milk their capital for management fees, but they will never, ever be able to go out and raise their next vintage.
So one of the gaps in the market here has always been, we saw this amazing craze of funds coming together for Series A, but then Series C or D or E is where it gets a little more difficult. And is money going to move further down the food chain?
Well, I think the earlier stage companies and focused investors, they were the least susceptible to the crazy valuations that were going on during this last cycle and at its peak. So there's just so much money you can put into a Series A company and justify in your raise as an entrepreneur. So that area, I think, is the best position to survive going forward. But venture at the end of the day is a very, very small asset class. So if you compare it to private equity, so private equity is like this, and then venture is like this, and good venture is like this. So it's totally different, and it's a very, very small asset class. So what happened during this last cycle at its peak is that you had a lot of, for lack of a better word, tourist capital that came in from mutual funds or hedge funds, and not to name names, but they came in because they couldn't differentiate themselves in terms of performance because interest rates were zero. Everyone invested in the same 5 publicly traded technology companies. So if you're, a big mutual fund company out of Boston, how do you beat your peers so you earn your bonus? What you do is you put on your tourist private capital hat, you fly out to Palo Alto, and you start writing silly checks. And that's what happened. And now that we've had the cycle turn, all of those tourists have taken off their hats. They've gone back to Boston and Baltimore and the other places on the East Coast, and they're not participating anymore. And the same thing you could say about the hedge funds and all the other folks that made the growth capital bit just so extreme in terms of overvaluation. So, I would be shocked if we see that type of overvaluation at any other point, in the next 20 years. Because again, I think it will be 19, 20, 21 growth tech, worst vintage of all time, worst.
Okay, the funds that have done extraordinarily well, 500 startups in this part of the world, have a number of unicorns, they will be able to raise money, and they will attract the best deals. They will get much better terms on those deals today than they were getting 3 years ago. Does this make it a kind of a less risky game for the successful VCs now?
So I think for the VCs that know that they're going to survive, and they know that they're not just in triage mode or milk the management fee mode, and again, there are a lot of those groups, but the groups that know that they're a viable, ongoing concern, they're in the catbird seat. Because again, for people that were giving the money during those 13 years, we were taking terms, not giving terms. And so it was a very difficult time. And so, these groups would come in, these growth guys, they'd come in, they say, hey, Marc, here's a term sheet, write in whatever you want the valuation, write in however much money you want, I pat you on the back and I'll see you in a year, good luck. And these groups were competing with, the more traditional VCs back in Silicon Valley, like either it's Founders Fund or Sequoia or Benchmark and so forth. And so it was actually a very interesting self-selection mechanism because if a young entrepreneur is given 2 choices between a benchmark term sheet, with proper valuation and an offer for proper help versus a blank sheet of paper where you just fill in whatever number you want and whatever valuation you want and hey, I'll see you in a year. If you choose this, God bless you. Because that means you're implicitly saying, I don't need your help. Maybe you don't. Maybe you don't need your help, but I'd like to think what venture capitalists do is actually add value. And because we got to such a silly extreme when money was not a differentiator and you could get it from anywhere, that's why these blank term sheets existed. And unfortunately, a lot of companies self-selected that way, no offense to them. And a lot of these companies were good, but for whatever reason, when you select that and then you go bust, it's very hard to bounce back.
Okay, so what happens to innovation and creativity and a little bit of risk-taking? So you talked about science projects. we're entering a very interesting time. I'll ask you about that separately. But does the new environment have an effect on innovation?
I think unfortunately it does. And people don't like to talk about this, but for startups that are heavily CapEx intensive, that's relatively fine when money is free. Today, when money is 5x as expensive, that's much, much, much more difficult. And so I think those companies in those sectors, I won't name them, you can figure them out, but if they are CapEx intensive and you're trying to raise Series A venture capital, that's a really difficult sell. So I think in that regard, innovation in these CapEx intensive venture businesses, they're going to have a really hard time raising capital.
And what are the sectors that you like right now? You knew that.
I hate this question. No one has a magic ball, whether it's Elon or Peter, certainly myself. I think you look back at all the investments done historically, and there's one common denominator, and it is the entrepreneur himself, herself. And so very blessed from going back to PayPal days, worked with some extremely talented people, whether it's Elon doing SpaceX or Reed doing LinkedIn or Chad doing YouTube, and the list goes on and on. We were very, very blessed. And I like to joke that Peter's best skill, myself notably excluded, was as a hiring manager. So he hired these amazing people. And so, we're not going to complain about that. And so we've been fortunate to be able to invest with them, alongside them, and just stay within that network and then invest in the people essentially that are their progeny, that they spin off and so forth. And so it begins and ends with these people because we know them. We've been in the bunker with them. We knew that when the bullets started to fly and we were having these near-death experiences that they were not going to get off and walk off the battlefield with the white flag held high. That's a big deal. And if it's someone that's just off the street that I don't know, that's not impossible to overcome. But similarly for me personally, I have a hard time with first-time entrepreneurs. And it's not a dogmatic rule, but a first-time entrepreneur, I just don't know when the bullets start to fly what his or her reaction is going to be. Because they could be completely cool and it's no problem and I'm here to see it out, or they could completely freak out. And that's the person that needs to go work at the consultancy company and start as a junior analyst and become a CEO. And again, that's a perfectly fine career path. But again, coming back to your question, it's all about the entrepreneur. And we were just so blessed because we work with so many talented people. I mean, when I met Peter, I was 24, 25.
I was going to ask you, now that you brought Peter and Elon up, I'm sure people would love to hear a little bit of your journey because, yeah, you said you were 24. What happened? Maybe just explain a little bit about how PayPal came to be.
Yeah, I mean, I got so lucky. I met Peter one of my first jobs out of college. We met through some common friends. He had this idea, which in effect was the predecessor to the predecessor of what would evolve into PayPal. He convinced me to come out and potentially join the team. All the people on the team at that point, I was employee number 9, so everyone was an engineer, and they loved to play these intellectual games as kind of part of the interview process. I'm like, I'm not an engineer, guys. I'm a marketing guy. So I don't know the answer to these questions, so let's save each other some time. Yeah. And we just kept going through these brain teases or whatever it is. But somehow, finally, I managed to kind of navigate the shoals and get through. I mean, if I ever write a book about all of it, the headline of my book, the title will be Dumbest Guy in the Room. And then the byline will be, the trick is getting in the room. And so it was just a really fortunate, lucky experience that I had. It's one of these things, I was enrolled to go to business school at UCLA. They'd already sent me this huge box of books that was required reading over the summer. I would have gone into debt, hundreds of thousands of dollars. I would have come out into a job market in 2001, which would have been atrocious. I got so lucky. And so my joke that I have with my buddies is that when I met Peter, I realized I'd met a really, really, really smart guy. And I vowed to hold on as long as I could. And fast forward, literally 25 years later, still hanging on.
Peter and Elon were kind of forced into a marriage. How did that play out, and what was it like to take those two behemoths and put them side by side?
It's Elon is so talented. He was running a company called X.com, which essentially was like a financial institution. It's too strong of a word because it was an early stage company, but he was using email payments as a way to attract and garner new customers cheaply to then upsell them to other financial products. It's not necessarily dissimilar to what he may be trying to do with X now. And then what we were doing at PayPal was just more of a pure play email payment company. So we were very much in a similar space. Elon had the benefit of being backed by one of the most famous venture capitalists in Silicon Valley, Mike Moritz from Sequoia. And so we were competing against each other. We were giving away, and this goes back to kind of the silly days that we've seen over the years, we were giving bonuses of $10, free money, to anyone who signed up for the service. So needless to say, not a great business model.
Yeah.
But it allowed us to grow at an exceptional rate. When we launched the service in January of 2000, we began growing at a rate of more than 1 million new customers per month.
What was your burn rate?
High. And what was even more problematic is that for us at PayPal, I think we had like 5 or 6 customer service folks in the company, and they all worked in our Palo Alto office. And we now have 1 million new customers. And the trick was, it's one thing if your business is selling Beanie Babies, because it's a Beanie Baby, who really cares? It's another thing if you're dealing with people's money. And if you lose their money, or their money's not there, or whatever it may be, because the next call is usually to the state attorney general, or to law enforcement, or something equivalent. So having 5 customer service reps to handle 1 million new customers per month and growing wasn't gonna work. And so one of my favorite stories from our PayPal days, we had a woman on our senior executive team, Julie, and so she's from Nebraska, and so she went out back home, and she went to Omaha, and she basically rented out the Motel 6 or whatever the equivalent was, and she essentially hired almost every single person that walked through the door that weekend. And if you fast forward to today, PayPal, I think, is one of the largest, if not the largest employer in the state of Nebraska.
Amazing. So just as we start to wrap up, let's contextualize for Asia, but I want to ask you this in a weird way, which is that you have set up a fund in Arizona.
Yes.
For multiple reasons, and I'd like you to share those with us. But one of the things that I find challenging is the brain drain when something isn't available. So the kids graduating from university in Arizona would typically head to the coast, I imagine. And that is a reality for many countries in this part of the world.
Yeah, it's a great question. So the topic of how do you kind of jumpstart a new ecosystem is something I'm very much in the weeds in. And so in Arizona, for context, put together a $110 million fund that we closed on about a little over a year ago. And so I won't bore you because there's probably not a lot of Arizona adherents here in the audience, but the gist of it is that Phoenix in Arizona is the 5th largest city in the United States. Arizona State University, which is in Greater Phoenix, graduates has the largest engineering school in the country. And so so I moved to Arizona after we sold PayPal to get out of the onerous tax regime of California. So I've been a resident there for over 2 decades. And so I've been observing the tech ecosystem, and it seemed to me that we've had the right ingredients in Arizona minus the capital bit. And because of that, our best and brightest, to your question, they didn't, because we've been a very real estate heavy economy, which is great. But if you want to do something other than real estate and you're top of your class at the ASU engineering school, you had to go fly to California or to Texas or New York or wherever it may be. And that brain drain, keeping our best and brightest locally, was a real problem. So a lot of them come back when they're later in their careers, they're married, they have kids because it's a great lifestyle, it's relatively cheap, the quality of life is high, you want to be around your great parents. That's fantastic. But we want to keep those young people there from day one. And so to do that, you have to have the right combination of these various ingredients. And in Arizona, it was the capital bit that was lacking. So you don't have that problem, obviously, here in Singapore. And this place has been booming. We were talking about it earlier. And you've got people coming from all over Southeast Asia, all over the world, frankly, to live here. And the capital bit is already here. So, it seems like you've got the recipe figured out pretty well.
Yeah, but it's not one market here. So I was thinking more about places like Malaysia and Vietnam and Indonesia, which national economies are all doing very strongly. But the funding to build regional businesses is, a lot of that is based here, but the revenues are generated in multiple markets. So tell me how you feel about Asia. You haven't been back in a while, but you're here. Are you going to put some money on the ground here?
Well, it's fun. I used to run the corporate international bit at PayPal, and so we had our largest international office here in Singapore, and we had investment from Temasek, Vertex, Singpost, Singtel, DBS, basically everyone in town. And so I'm actually going to see some of these folks later today just as a quick hello. So it's really fun to be back. This is a fantastic place. It's so properly run, so properly organized. So I'd be very, very bullish on Singapore in terms of what's going on here. Because I think you have literally all the ingredients. Like we were talking earlier in the green room, I always like to think about, what is the bear case wherever you may be? And so, in Arizona, for example, I think, really we control our own destiny because we live next door to a state in California, and I can say this because I'm personally a California refugee that is going through a lot of hard times. And I think the exodus out of California is going to last a long, long time. So if it's an American baseball analogy, it's still the first or second inning. And proximity matters. And I think proximity similarly matters here in Singapore because you have all these, whether it's Indonesia, the list goes on and on. You guys are going to be the place where you can capture the best and brightest, and then you can spawn out into these markets. And that proximity is a huge advantage.
Amazing. Jack, that's all the time we have. It's been wonderful chatting with you. Thanks very much.
Thank you.
Everybody. Thank you to Jack.
Thank you.